Welcome to Charged Alpha. I'm Hudson, joined by Lana. Today's chapter, JD.com, the Chinese e-commerce platform that posted a 37% EPS beat and saw the stock barely move.
JD.com was founded in 1998 by Richard Liu as a physical electronics store in Beijing. The SARS epidemic in 2003 forced the business online, and it never returned to physical first retail.
JD listed on NASDAQ in 2014, the first Chinese company listed in the U.S. via a non-VAE structure at the time. A secondary listing followed on the Hong Kong Stock Exchange in 2020.
Sandy Xu became CEO in 2023, succeeding founder Richard Liu, who transitioned to an advisory role. Xu had previously served as Chief Human Resources Officer before leading the company.
Most recently, Q1 revenue was RMB 315.7 billion, approximately $43.5 billion US, growing 4.9%. Non-GAAP EPS of 74 beat the 54 estimate by 37%.
95% of covering analysts rate JD a buy, 37 analysts at consensus. The post-print stock move was just 1.5 to 3%, muted relative to the EPS beat magnitude.
JD's moat is its direct fulfillment model. Unlike marketplace peers, JD owns its logistics network and sources inventory directly, enabling same-day delivery and guaranteeing product authenticity.
The food delivery segment is narrowing losses sharply, the core story of this quarter. Loss reduction flows to EPS, explaining the disconnect between slow headline growth and strong earnings.
JD Logistics is approaching profitability as a standalone unit. The logistics build-out, originally an internal cost center, is now generating external revenue and becoming a margin contributor.
Against Alibaba, JD competes on logistics reliability and authenticity. Against PDD, which wins on price, JD holds the quality and trust segment of Chinese e-commerce.
The U.S.-China tariff truce is a macro tailwind. Reduced trade tension supports Chinese consumer discretionary spending, the category most directly tied to JD's GMV and logistics volume.
The muted stock reaction reflects headline revenue growth near 5%. Investors are asking whether JD can re-accelerate the top line, or whether margin improvement is the entire story.
Regulatory risk in Chinese e-commerce is a structural overhang. Platform regulations, data compliance, and antitrust scrutiny create a persistent discount on Chinese ADR valuations.
Sandy Xu's thesis is to complete the logistics to profitability transition while maintaining JD's quality positioning, the founder-built market share. Her task is to extract the return.
JD's long-run advantage is trust. Authentic products, next-day delivery, and after-sales service are non-negotiable in a market where counterfeit risk is real.
JD Logistics serves external clients beyond JD's own platform. As external revenue scales, it becomes a separate earnings driver, reducing JD's dependence on e-commerce GMV alone.
JD trades at a discount to global e-commerce peers, reflecting the China regulatory discount and slow headline growth. The EPS beat trajectory could compress that discount over time.
JD.com just posted a 37% non-GAAP EPS beat as food delivery losses narrowed sharply, and the stock barely moved.
Let's get into what the muted reaction tells us and whether the JD thesis has changed.
Food delivery turning profitable, logistics scaling externally, tariff truce tailwind, JD is building margin velocity into a low-growth framework. Now let's get into the numbers.
JD.com beat earnings consensus by 41% and the stock barely moved. Revenue of $45.8 billion, up nearly 5% year over year. Non-GAAP EPS of 74 cents against a 50-cent estimate. JD Logistics up 29%. By every standard scorecard, this was a beat. So why did the market shrug?
Welcome to Charged Alpha. I am Lana here with Hudson. The reason is a 10.3 billion RMB operating loss in food delivery, nearly 8 times larger than a year ago. This is a land grab story inside an earnings beat, and we are going to break down every layer.
JD.com is a Chinese e-commerce and logistics company headquartered in Beijing, founded in 1998 by Richard Liu. The company employs roughly 570,000 people and operates its own nationwide logistics network, which differentiates it fundamentally from Alibaba's marketplace-only model. JD actually owns the inventory and the trucks.
Sandy Xu has been CEO since May 2023, after Richard Liu stepped down in April 2022. The business spans first-party retail, third-party marketplace services, JD Health, JD Logistics as a standalone revenue unit, and now a food delivery segment that is burning cash at scale in a war against Meituan and Alibaba's LA.me platform.
Q1 2026 net revenues came in at RMB 315.7 billion, approximately $45.8 billion US dollars, up 4.9% year over year. They beat the RMB 311.4 billion estimate.
Non-GAAP diluted EPS hit RMB 5.12 per ADS, approximately 74 cents, versus the RMB 3.64 estimate of 40.7% beat. This is the number that generated the headline excitement.
Here's the critical context that the headline hides. Non-GAAP EPS is down 39% year over year. Q1 2025 was RMB 8.41 per ADS. The 41% consensus beat is entirely against a depressed estimate bar, not against year-over-year earnings growth. JD earned less per share than it did a year ago.
Product revenue, the core first-party retail business, was up just 1%. Electronics and the 3C category, which historically drives JD's top line, remained sluggish. Service revenue was the bright spot at 20.6% growth, now representing 22% of total revenue.
JD Logistics was the standout. Revenue hit RMB 60.6 billion, up 29% year over year, with operating margin improving from 0.3% to 1.7%. That improvement in logistics profitability is the most structurally important number in the entire print.
Annual active customers surpassed 740 million, a company record, with 10 consecutive quarters of double-digit user metric growth. Daily necessities grew 14.9%. The consumer platform is expanding even while the core product revenue category stagnates.
But food delivery is where the narrative fractures. Operating loss in that segment reached RMB 10.3 billion in Q1 2026 versus RMB 1.3 billion in Q1 2025, nearly 8 times larger. Marketing expenses jumped 45.8% year over year. EBITDA margin compressed from 4.6% to approximately 2.5%. That is the food delivery war showing up in real time.
Sandy Xu has positioned food delivery as a strategic defensive necessity, a high-frequency consumer touchpoint that drives cross-sell into JD's retail categories. The argument is that a consumer who orders lunch through JD is more likely to buy electronics through JD next month. Whether that adjacency math works at the scale of a 10 billion RMB per quarter burn is what the market is still evaluating.
Wall Street's read on this print is divided along one fault line. Is the food delivery investment a rational strategic bet that JD can afford, or is it a margin-destroying distraction from the core business? That question defines every analyst note.
The bull camp argues this is a defensive necessity. Meituan is the most valuable consumer internet platform in China. If JD does not contest food delivery, it seeds high-frequency consumer touchpoints that compound into lifetime value across every JD category. The spend is painful but rational.
The bear camp points to EBITDA margin compression from 4.6% to 2.5% in a single year. A services business compressing margins by 200 basis points, while EPS declines 39% year over year, is not executing a winning strategy. It is funding a war it may not win.
The standalone value of JD Logistics has become a key discussion point. At 29% revenue growth and improving profitability, several analysts now model JD Logistics as worth $20 to $30 billion as a standalone entity, close to half of JD's current total market cap. The sum of the parts, undervaluation thesis is gaining traction.
Chinese ADR discounts remain a persistent headwind. Ongoing U.S.-China trade tensions, regulatory risk, and residual delisting concerns continue to suppress the multiple JD trades at relative to comparable U.S. e-commerce platforms. That structural gap may not close regardless of how strong the operating results are.
The bull case is layered. 740 million active users is a record. JD Logistics is compounding at 29% with margin expansion. Net cash of roughly $19.3 billion means JD can fund the food delivery war for years without accessing equity markets or cutting the dividend.
At a dividend yield of approximately 2.8% on a $26 billion market cap, income-oriented investors are being paid to wait for the food delivery investment cycle to peak. If JD captures meaningful food delivery market share and losses begin declining in 2027, the margin recovery from 2.5% EBITDA back toward historical levels would be a significant earnings event.
The bear case is direct. EPS down 39% year over year is the real number, not the consensus beat framing. The 41% beat simply means analysts had their models too low, which says more about consensus forecasting than about JD's underlying earnings power.
Food delivery losses ballooning eightfold in a single year suggests there is no near-term ceiling on the spend. Meituan is not backing down, and Alibaba's Ella.me has deeper pockets than JD does. The competitive dynamics in Chinese food delivery are the most intense in global e-commerce right now.
Product revenue up just 1% shows the core first-party retail engine is barely growing in real terms. Electronics and 3C categories face structural competition from Pinduoduo, Taobao, and ByteDance's Douyin Commerce. If JD cannot accelerate core retail, the food delivery investment makes the margin compression worse without a revenue offset.
Options activity around the print was muted. Implied volatility came in low, consistent with a Chinese ADR that trades at a compressed multiple. The options market was not pricing a large directional move, and the 3% stock reaction matched that calm baseline.
ADR investors have been net sellers for 2 quarters as the food delivery losses surfaced in the operating results. No notable insider sales were tied to this report. The net cash position of $19.3 billion is actually a hidden strength. It signals that JD has the balance sheet to fight this war, even if the cost is painful.
The dividend yield of approximately 2.8% is keeping income-oriented long-term holders in the name, even as growth investors rotate toward cleaner China earnings stories. That dividend acts as a real floor on the stock. JD paying 2.8% while holding $19 billion in net cash is a signal that management is committed to capital return alongside the investment cycle.
The near-term catalyst is food delivery loss trajectory. The market needs a peak signal, either explicit management guidance that losses will stabilize in 2026, or actual Q2 data showing the rate of increase is slowing. Any sign that the 10+ billion RMB quarterly burn is becoming 10- billion would be a meaningful positive inflection.
A JD Logistics monetization event, a formal spin-off, IPO, or strategic investment, would unlock significant shareholder value given the 20 to 30 billion standalone valuation that analysts are modeling. JD Logistics is profitable, growing at 29%, and owned inside a parent company, trading at a discount to that subsidiary's standalone worth.
Risks include the food delivery war intensifying further with no path to profitability in the near term, continued weakness in electronics and 3C product revenue, regulatory tightening on Chinese platform companies, and RMB depreciation, compressing dollar-reported earnings for ADR holders. The structural ADR discount may also widen if U.S.-China geopolitical tensions escalate past current levels.
JD beat EPS consensus by 41%, but earnings are down 39% year over year. The food delivery war explains the disconnect. JD Logistics is becoming a world-class standalone business. The question is whether management wins the war before the losses erase the logistics profits. Watch food delivery loss trajectory and any logistics monetization news. Subscribe to Charged Alpha for the next update. Charged Alpha content is for educational and entertainment purposes only. Nothing you hear on this show should be taken as financial advice. We do not hold positions in the securities discussed, unless explicitly stated. Always do your own research and consult a qualified financial advisor before making any investment decisions. This is Charged Alpha. We charge forward, so you stay informed.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.